these views that I'm going to put forward now are very much my own and not those of my institution. Although, of course, it reflects the work that I do day to day. So the title I've chosen today is Independence, Interdependence and Dependence in Europe. And the way that I'd like to sort of organize this presentation is a little bit by giving a bit of a framework that I think is applicable in a variety of integrated systems. And then once we've sort of established that framework, thinking about how that applies in the context of this current European crisis, and then what we can really draw from that on a broader scale. So to start, this is what I perceive to be the fundamental relationship you have in an integrated system where there's choices, where there's people who are independent, they can act in a free way, but because this is a system that has lots of interlinkages, lots of connections, those independent actions affect everybody else within the system. And so this creates a kind of natural tension, really, between independence and interdependence, which can be both positive and negative. People can benefit a lot from each other's actions. They can also suffer a lot. And in a system like this, particularly because interdependence is often extremely complex, and it's very hard to understand the degree to which your actions are going to impact on everyone else within this system, independence needs a guide for action. You need a way to understand how to guide your actions so they're actually mutually beneficial and not mutually harmful. And let me just give a few examples of what I mean. So if we start, so we need this guide, we need a guide for action. And in the framework which I'm sort of putting forward, I want to make the argument that the guide for action is actually an understanding of dependence. So interdependence and interdependence is often how we understand these connected systems. But really, actually, if we're going to understand how to behave within this system, we need to understand dependence. And by that, I mean to understand the thing that really sustains us, that sustains the system. And you can understand this ex ante or ex post, and I'll explain what I mean by that now. So let's take an example of society. This is something that we all know very well. We all live in one. We're all citizens in this society. We're all connected by relationships. And if we can act in a way that's constructive, that's based on kind of reciprocity and kindness, and in doing so, this strengthens the thing that we depend on, our community, and actually therefore makes independent action possible. On the flip side, if we act in a way that doesn't have a clear guiding principle, and we act in a way that's actually harmful to one another, we undermine the thing we depend on, which is the community, because if this doesn't exist, if we don't have safety, stability, then there's actually no potential for independent action at all. And what I mean by ex ante or ex post is that we can understand this ourselves and behave in this way, or in a sense we can have this forced upon us. And in most of our societies we have both these things. I mean, we hope that it's mainly this, but we also have these sort of law or policy as a kind of insurance policy to make sure that we do the right thing. But this is only possible because we understand this. We understand that community is something that we all depend on, and then this can be used to kind of shape and guide our actions. To give you another example, in sort of an environmental context, as organisms, particularly those with a free choice like us, we can act in a way that's sustainable and strengthens the kind of ecosystems on which we depend, or we can act in an opposite way, which then undermines those ecosystems and makes our existence impossible. But the key to this is that we understand that we're in an ecosystem. So then we can act sustainably and responsibly, or we can put in place kind of insurance mechanisms to, like conservation protection, to make sure that we have the same effect. Or then just coming to a third example, in the economy, an economy functions essentially because you have a high degree of kind of trust and responsibility in the system. Because if you don't have trust and responsibility, or prudence, that I've put there, then it's almost impossible for people to do anything, because no one, you'd have to have reams of contracts and what we call kind of transaction costs in economics, which would mean that it'd be so hard for anybody at any distance to really transact with one another that you wouldn't have an economy. And so it's this understanding that what we depend on is this functioning market that allows us to behave in a way that supports this system ex ante and ex post through kind of regulation intervention. and that allows this system to actually function as an integrated system. And I say my key point is that if you don't understand this thing you depend on, then as an independent actor within this system, you don't actually have any context or any way to guide your actions. And now to move to the thing that I know best, which is the Euro area, which is the 17 countries that have adopted and that use the single currency. And this was actually a system that was designed explicitly to balance independence and interdependence. Because we agreed that we'd have a single currency, that we'd all have a single interest rate, we'd have a single market, but we also agreed that because we're still 17 countries with different priorities and different ways of doing things, that countries would still have their own economic policies. That if some countries wanted to tax more and spend more, they could. If some wanted to tax less and spend less, they could. And this was a way of combining the fact that we have very, very different histories in Europe, different languages, different cultures, but we're trying to move to a situation where we're more integrated. And so ideally, we set up this system to work so that countries would have their own economic policies, but they would be expected to treat these policies as a matter of common concern. This was written into the EU treaty, in a sense, to behave in such a way that they wouldn't create negative effects for the others. And if this didn't work, we had in place these sort of rules and oversight frameworks. The most well-known was something called the Stability and Growth Pact, which was supposed to make sure that budgetary policies, fiscal policies, were conducted within a particular limits so that you didn't create these other problems for the other countries in there. But my main contention, really, and the reason I think that we've got into the crisis now, is that there was no clear concept at this time of what it was that we actually depended on in Europe. It was sort of understood that, it was sort of hoped that this thing could just balance itself naturally. The countries would just do the right thing, or that they'd exercise these rules. But there was no real focus for this, no real focus to actually guide why you should do this. And my point is that actually what really wasn't acknowledged is that once they made this decision to take on a single currency, to become part of a single union, they actually became a political union. And what I mean by a political union is that they became mutually dependent, that problems in one country affect another country, and solving those problems is only possible through collective solutions. But no one really acknowledged this because it was politically difficult. And no one really wanted to say to their national publics, actually now we're not separate states anymore, we really are de facto a political union. But because this wasn't acknowledged, there was no real guide for action. And this, in my view, is the backdrop of the crisis that we've come into. So yeah, as I've explained, this situation of de facto political union meant there's no guide for independent action. And so therefore nothing in either these ex-ante or these ex-post mechanisms to make sure that independence and interdependence are actually mutually supportive and not mutually destructive. And because we didn't have that, what you experienced over the first 10 years of the euro was actually a considerable degree of divergence. Countries went in completely different directions, when actually in having a single currency, what you need is convergence. I mean, it's evident because there's a number of things you don't have anymore, like an exchange rate, your own currency, your ability to set interest rates. So you need to converge. And actually, because they didn't have a guiding principle, they diverged. And I'm just going to demonstrate this in a few examples. I'm going to show some charts now. The point of these charts is not to really understand exactly what they're saying, but to demonstrate some of these relationships that I'm talking about. So, I mean, what you just need to appreciate there really is the red. I mean, the red tells you that a country was doing something that was not in line with what was defined as a kind of safe budgetary position. And that's from 1998 to 2007, which was now recognized as an economic boom, as a time when countries should have actually been in a healthy position, should have been consolidating public finances. And you can see that there's a huge amount of red on there. And that's a story of divergence in fiscal policy. Then if we come to my next thing, which is competitiveness, this is basically how competitive a country is internationally. And this is critical in a monetary union because you don't have an exchange rate anymore. You can see this orange line is Germany, which is 100. So this is a chart that shows others relative to Germany. And you can see from 1998 to 2010, you get this enormous divergence. And these are you see this is Spain, Greece, Ireland, and Portugal that are shown here. Countries completely going in an opposite direction from the largest kind of anchor country. And then the effect of this is then this, which is that you get this huge divergence in their trade balances as well. So you've got some countries which are running huge surpluses, others which are running huge deficits. Unfortunately, we just tended to look at this, which was the average, and say everything's fine. But clearly, behind the scenes, you can see that it wasn't at all. And these were the problems that were building up over 10 years. And then also in credit growth, I mean, this is a graph that shows the relationship between the amount of loans in the economy and the increase in house prices. And you can see you have Spain and Ireland up here, where there's almost a perfect correlation between credit growth and a housing bubble. And then Germany down here, where there's none at all. And I mean, in a country that had its own central bank, its own monetary policy, if you were up here, you'd raise interest rates to try and slow the economy down. But because you're in a monetary union and you're looking at the averages, you have to take into account this, which is the biggest country, and so you can't raise interest rates because you're looking at average positions. And so then you're getting this considerable divergence across these countries, which is creating a very, very vulnerable situation. And then what happened next is, of course, that the financial crisis started, and a lot of countries suddenly entered into recession. They had a collapse of tax receipts, housing prices collapsed. They had to spend a lot of money bailing out the banks. And what really happened in Europe, I mean, there was the first phase of the crisis, it was, of course, the financial one. But then we entered into a second phase, which started here, when basically because of, let me just have a drink of water. Because of these problems that I just identified over the last 10 years, markets suddenly kind of woke up and realized, hang on a second, it's not all fine. You know, there's some countries that have run some very kind of irresponsible policies over the last 10 years. And now the crisis has sort of exposed the situation that they're in. And what this blue line shows you is the increase in borrowing costs for Greek government bonds. And you can see for this whole period, even though these vulnerabilities were building up, the markets thought everything was fantastic, it was all euphoria, you know. But then suddenly there was this sudden change in assessment and a complete loss of confidence. And I mean, this graph here illustrates what happened pretty vividly, is that this shows you the trading, the volumes of trading for Greek government bonds. That basically it just turned off. That suddenly people realized actually there was just a sudden switch in sentiment where they realized that there were these huge underlying problems caused by this divergence, and it just switched off. The markets just closed down. And I mean, this wouldn't really be such a big deal if it was just isolated to Greece. I mean, Greece would have to, you know, make an adjustment, do what it has to do what any country has to do, really, that encounters economic problems. But this, of course, happens in the context of very, very high interdependence. And when you have a single currency, you get these enormous cross-border linkages. You know, banks have cross loans, lots of different countries, they're all holding each other's debt. And so a problem in one country is automatically spread to others, both directly and also in terms of perception. So, I mean, you can see this top line is Greece. But you can see when markets started to have doubts about Greece, then they also started to have doubts about Ireland, they started to have doubts about Portugal, and later they started to have doubts about Spain and Italy as well. I mean, actually, if I took this graph now, it would be somewhere up here. It's interesting if you look at this to see the way that these things are actually grouped. You know, that it's very much a kind of perception that because you're sharing a single currency, markets think that you're exposed to the same problems, which you are, of course, but it's also a perception driving reality, really. And you can see the way that what this graph is showing you is borrowing costs, increases in borrowing costs for these countries when markets start to doubt whether they're actually solvent. So you see these effects of a crisis in one very small country get propagated to all the others via this interdependence. And then also to banks. What this is basically showing you is the degree to which problems, when markets have doubts about a country, they also have doubts about the banks in that country. And this line is a kind of one-to-one increase. So the more you doubt the country, the more you doubt the banks. And you can see that this is, in these 4 countries here, it's very strongly correlated. That when they start to doubt the countries, they also start to doubt the banks. And then this spreads again the crisis onto another level, which is into the sort of domestic financial sector. And because of this interdependence that I've talked about, it's impossible to say really when this is going to stop. I mean, I showed you Greece first, then you saw these other countries, Spain, Portugal, Italy. But, I mean, if you look at this, you see that since the start of the euro, there's been an enormous increase in the amount of financial instruments that are held cross-border in the euro area. That's what this line's telling you. So this debt is spread everywhere. If one country gets into trouble, if there's a risk of default or a default, this is spread everywhere. It's completely interconnected. And you can see here in the case of Greece, for example, that this is the amount of its debt here that's held by non-residents. It's held by people who aren't in Greece. So any problem in Greece is automatically transferred to all the other countries. And this includes Germany, this includes France. I mean, really the core countries. No one's really safe from this. And so now coming to the question, why can't we stop this? I mean, it's clear that that there's a kind of a self-fulfilling dynamic going on. That because of this interdependence, the crisis is spreading and spreading and spreading, and we're unable to really stop this crisis to get ahead of the curve. And my contention for this is that the reason we can't stop this is that countries haven't acknowledged the situation that we're actually in. I mean, people talk about that we need to have more Europe or more political union or this kind of thing. But what they don't acknowledge is that we're already in that situation. We're already a single union. This is just the case. When you're in a situation where the problems in one country affect everybody and the solutions for one country have to involve everybody, that's a political union. And at the moment, our perception continues to lag behind the reality of this situation. So we still think these are national issues, that, it's a problem for Greece, it's a problem for islands, and that national solutions are acceptable. But in a sense, you can't solve a problem until you accept the reality of that problem. And this issue of this perceptions lagging behind reality means that you end up with an approach that's actually not working for anybody. What I've called a zero-sum approach, which means that you see a situation where one person's gain is another's loss. So a gain for the German taxpayer is a loss for the Greek taxpayer, or vice versa. And because this is actually no longer the case, that a gain for the German taxpayer is also a gain for the Greek taxpayer, and vice versa, this is actually leading to a situation which is just suboptimal, which is where no one can really get ahead of this crisis. And let me just illustrate a little bit what I mean. So from the kind of creditor side, the sort of stronger countries that are being expected to support the weaker countries, you can see if you look at Germany, this is a poll of, would you support your government helping Greece cope with its budget deficit? And this is the oppose column. And this is, I've mentioned Hart's fear down there. I mean, a lot of this is to do with the way that this problem is described. It's these kind of lazy Greeks who retire at 50, and there's a lot of very negative stereotyping in the media. But I mean, in a sense, this kind of negative stereotyping is inevitable. I mean, there's a program in Germany called Hart's Fear, which is for people on unemployment benefit. And Germans all think they're all lazy and they retire at 50 and whatever as well, but they don't mind. In a sense, people accept the fact that you have to support those people because they're part of the we that is Germany. I mean, the we in inverted commas. Whereas, at least in the popular perception at the moment, Greece isn't, you know, or Portugal. I mean, they're some kind of southerners who are distant from us, even though what they're doing and what's happening in those countries is directly affecting German citizens. They don't perceive it like that, even though that's the reality. And it's also true from the debtor side. From the Greek sides, you know, there's a tendency to kind of see this problem as somebody else's problem, that it's the fault of the banks or it's the fault of the speculators or whatever. And you can see in these graphs, I mean, this is the party in Greece that's trying to kind of save Greece from bankruptcy. And it actually has a lower support than the main opposition party and then the kind of others category. Although this also kind of reflects a lack of faith in politics generally. And that graph tells you that Greece recently passed a new kind of program to try and get the budget under control. And that's the margin by which it passed in the parliament. So, in a sense, also from this side, the Greeks don't, in a sense, see themselves as part of the we that's Europe, in the sense that they recognize that they need to accept a certain degree of sacrifice for the benefit of everybody else. And until they accept that degree of sacrifice, everyone else kind of continues to suffer. But you can also understand that this is a standoff. You know, why, if from the creditor side, they perceive this, that there's no sort of solidarity or willingness to accept sacrifice, you can see why they don't want to open the checkbook. From the debtor side, if they think they're being punished, if they think that they're being treated as kind of miscreants, you can see why they're not really excited about making all these cuts to benefit everybody else. But this isn't really a situation that can last. I mean, this graph shows you basically the trajectory of holdings of Greek government debt. So by 2015, this is the amount of Greek debt that will be held by other European countries through the fact that they're bailing them out, that they're supporting them. And this is the amount that will be held by the green line is by the amount that will be held by private sector, by the financial markets. And you can see that this just can't work. I mean, if the creditors don't see the Greeks as worthy of support, if the Greeks don't see the creditors as worthy of a degree of sacrifice, something's going to break down before you reach this point. And I think we're already approaching that point at the moment. Let me just, sorry, have a glass of water. And so I mean, how do we get out of this, really? I mean, clearly the situation at the moment is just not one that's sustainable. And basically, I can kind of see two ways forward. One which is a sort of ideal way, and one which is a more probable way. And this actually links back to what I was talking about at the beginning, about the fact that when you have something you depend on, you can get there ex ante or ex post, but ultimately you have to understand that thing you depend on, and you have to support that thing. Otherwise, the system of independence and interdependence breaks down because of these things that I've just demonstrated. So I mean, I guess this is the kind of ideal way ahead, is that we actually recognize that our perceptions are lagging behind the reality of the situation, that once you share a single currency, you are already in a single union, and then you actually put in place policies that reflect this, instead of this kind of piecemeal national stuff. You say, okay, if we're a single union, then what does a single union need? And there's various approaches. I mean, I don't know, I could go into them in detail, or maybe in the questions, but for example, issuing debt together, or having a much closer sort of budgetary cooperation, or much stronger rules for the policies, because you accept the fact that you're all affected by these things. And at the kind of level of the citizen, to kind of paraphrase a line that was sometimes maybe used in the first symposium, you kind of see other Europeans and yourself as oneself, rather than, you know, this is what has to underlie really a sense of community, and the willingness to give and the willingness to sacrifice has to underlie a fact that you see this as a kind of a oneness. But as I said before, it only works if everyone's prepared to submit to that, which doesn't seem very likely at the moment. And so this would be the kind of ideal ex-ante approach where we do this ourselves in a voluntary way and actually in an enlightened way. But this is what I see as a more likely approach, which is it's sort of forced on us, the ex-post approach. And that's that we really don't, you know, we don't see that that we're already in a single union. And so we keep doing these zero-sum approaches or these national trade-offs or, you know, all this talk about red lines and these kind of things that, for countries. And that means it's just the market that keeps forcing the process. There's a crisis and another crisis and another crisis. And so we kind of incrementally respond to this with closer integration because it's the only way to stop the crisis. But it means this happens in a deeply undemocratic way, that this happens in kind of late night meetings at 2 a.m. where they agree to something and then have to kind of convince people afterwards or not at all or just do it. And people never really understand why this was necessary. You know, they're just told that it's unavoidable, you know, it's that or disaster. And then there's this kind of popular resentment. You might go along with it, but you don't go along with it willingly. And then the kind of basis for that is not this idea of Europe and yourself as oneself. It's really just fear of the alternative, that you have to do this, otherwise there'll be a disaster. And there's a nice quote actually from John Kenneth Galbraith, actually, who's a very famous economist. And he said that politics isn't the art of the possible. It's a choice between the disastrous and the unpalatable. And it's really, that's the dynamic at the moment. You know, you reach a point where there's a crisis, and so you go the unpalatable rather than disastrous. But it's not really any way to build a community. And it relies a lot on a climate of fear. There's always a high risk as well in such a climate that you do the wrong thing. When you go to the precipice and you look over and you say, okay, no, we'll go back. But I mean, it's not out of the question you go to the precipice and you go over. I mean, we've seen that in the 1930s. Also almost saw it in 2007 when Lehman Brothers failed and then the Congress initially voted down the rescue package. I mean, there's always risks in that situation. And maybe in the end it ends up in the right place, but it's not a path it's an oppressive path rather than a voluntary one. But my contention is that ultimately it has to happen, because if you depend on something, you can't avoid it, because you just do depend on it. It's not a choice. And in Europe, we do now mutually depend on one another. We're in a political union. There's no going back. And so at some point, you have to accept that is what sustains the situation that you're in. And so I'm just going to kind of come to a conclusion, a sort of more general conclusion, and about what this is sort of telling us about the world more generally. And I think that in a lot of domains now, we see high levels of independence, you know, in the economy, in the environment, politics, and things seem so complex that it's very difficult to really get a sense of how you can act constructively within these systems, how you can appreciate these knock-on effects, which are so diverse and rapid in many cases. And my contention is that the only way that you can really have a real guide for action in an interdependent system is by understanding what you depend on. And I think that applies at every level. I think that applies for people, for societies, nature and economy. I think even at a spiritual level. It's really only by understanding the thing that you depend on that you can understand how to actually moderate your actions so that they're constructive. And that they are positive for other people rather than negative. And I think that actually this understanding of what sustains you in any particular integrated system is really the understanding of what real empathy is. That what you share in common is single, it's indivisible, and it's the thing that without which none of you are able to actually prosper. This is the foundation for having real empathy towards other people, I think, because you realize that this is